Hello, everybody, and welcome to today's GolfSuites and InvestorsAlley webinar. Please feel free to submit questions through the Q&A. We'll leave time to answer any questions at the end of the presentation. For today's presentation, our host is GolfSuites Chairman Gerald Ellenburg. Jerry has 40 years experience in real estate, finance, and development. He was the founder and general partner of one of the largest holders of manufactured home communities, acquired over 100 properties totaling more than 40,000 rental units across 26 states, principal in over 900 million of transaction value. His expertise includes accounting as a CPA and founder of Hampton, Ellenburg, and Carpenter CPAs, public accounting firms specializing in finance and taxes. He has a vision to create an engaged collective of investors at GolfSuites, bringing to light his unique combination of financial and operational experience. Welcome, Jerry. I'll turn it over to you.
Well, thank you, Beth. Thanks for hosting us here. You're a great producer, and great thanks for putting all this together. So why don't we get going here? And let me say welcome to you subscribers of InvestorsAlley. It's a new relationship for us. We love this company. We've got a good handful of, a couple handfuls of investors come in to GolfSuites from InvestorsAlley, and we had the idea with the managers to start, producing some periodic seminars, and want you to know that on all of the webinars we do, we have new investors come in with interest. And we have a ton of existing shareholders that keep watching these webinars as they kind of get updated and learn more about, the investments they've already made. So let's get right to it then. The first thing I usually say is that I liken this to at least a scant familiarization with a company called Topgolf. Topgolf kind of invented this discipline. They invented this form of golf entertainment, food and beverage, sports bar combination, and came over here from the United Kingdom and now operate 50, 60 of these locations. They have done a very good job of proving the concept, which is very common in industry, just like public storage proved the mini storage concept 5 or 6 decades ago. We decided to come into this industry because it's way undersupplied, it's way over demanded, and we wanted to put together a collective, a family, if you will, of investors to own this with us and do smaller locations that we could build faster, open faster, and take shareholder capital and spread it out to a wider number of locations. So instead of doing $30 million in one location, we'd like to do $5 or $6 million in 5 or 6 locations. And we can get into that through this discussion as we go through the evening. We are very golf centric, and we're very food and beverage centric. Food and beverage constitutes approximately 2/3 of our revenue. So we've done a very effective job of bringing in that management contingent, highest in the industry. And we just offer a very good combination of game improvement, fun golf, for anywhere from good 5 handicap golfers to absolute beginners and hackers. It's just a great entertainment concept, and the country has room for literally hundreds of these facilities, and nationwide, with all of the competitors in count, there's probably less than 80. There's probably 15 to 20% existing sites today compared to how many there should be. So let's go ahead for the next frame. Some of your base statistics here to start with is that we are now learning that roughly half, 50% of all golf now is played off course. What does that mean? When I was being raised, you played golf on a golf course, you played 18 holes, you left the house at 8 o'clock Saturday morning and you were home for dinner. That was a very conventional format. It still exists and it's still strong. But as the population has increased and the baby boomer population is giving way to younger generation, younger generations, this time commitment of traditional golf has become very constrained. People are more family oriented. They're doing other kinds of things. They want to have involvement with their kids. And so this concept of going to a golf entertainment center, be it Topgolf, be it GolfSuites, be it Drive Shack, any of us who are in this business, is very attractive because you can go in for half an hour, you can go in for 2 hours, you can go in for all day. You can really do whatever you want. You're hitting golf balls, you're having some cocktails or drinks or soft drinks, and you're eating hamburgers or pizzas or any of the food offerings that we have. You're watching college football, you're watching Major League Baseball, World Series, anything you may want to do. It's pretty much a sports bar combined with a driving range, and the driving range offering you all kinds of golf options that we'll talk about. So we're appealing to a shifting culture in terms of what golf has become. And so that's point one. The design of the stock itself, these next two items you see, is that number one, in buying our shares, you're buying preferred stock. And whenever I come to this point, I ask whoever's on the webinar to go to Google and actually look up the definition of preferred stock. That's a very critical definition that you need to know in owning stock in our company. Excuse me. Preferred stock essentially is first money out, so that at any point in time where the company, excuse me, just come off a cold here, refinances or sells or merges, your investment gets paid first. And we who own common shares, we members of management, the founders, get our money after you. So if you invest, say $10,000, we go into a sale, we go into a major transaction of some kind. The first thing that happens is you get your $10,000 back. We then go into an equity sharing where the gain is computed. And if you were to be in this investment, say 3 years, 4 years, you get equity upside with that. You'll get growth of the company with that. The second feature you see there is the 8% annual dividend. We've now paid this dividend for over 3 years. It is earnings backed. It's not subsidized by management. We have cash flow, positive cash flow in our existing facilities that pay these dividends. They are virtually tax-free. Legally, I have to use the term tax deferred. These are not municipal bonds, which is really the only thing that is tax-free. These are tax deferred in that you're receiving dividends from a company that doesn't have to pay income tax yet due to phenomenal tax advantages we have under federal income tax law, depreciation, amortization, various treatments that we get that allow us to take heavy deductions against the cash flow. So for all intents and purposes, you will receive an 8% dividend and you will not be paying tax on it for quite some time. Those are the three key elements here. I think that in advising clients, I get asked this, I say, listen, you've got two objective reasons and one subjective reason to come into this. Presuming you like the discipline, presuming you like the concept of golf entertainment, presuming you understand that we are the only company that exists in which you can buy ownership this way. We're the only company offering shares to shareholders who are strictly in this business. Other competitors are owned by larger companies and don't offer this. Point one is this preferred stock, first money out. Objective point. Objective point number two, 8% tax deferred dividend. And then the subjective point number three of the potential of equity upside. This chain today is operating 3 facilities. We own a 4th site. We just went into agreement for a 5th site literally today. And we have a 6th site in mind. We have a very aggressive but responsible growth plan. We wake up with 15, 20, 25 locations. You're going to see that equity upside really, kick in nicely. So 2 objective components, 8% dividend, preferred stock, first money out, and 1 subjective component, which is the equity upside. Okay, Beth, you can advance this. Our target market, there's some shots, by the way. That's one of our servers out at the Tulsa location. If you look up to the right there, that's our Tulsa location on the Arkansas River in Tulsa, Oklahoma. Very picturesque, beautiful. I was just there the last 2 days. It's a beautiful facility. We are going to secondary markets, and we're building 40-unit facilities that we can build and open in less than 1 year. That is very important to us. We call that speed to revenue. To do big 3-floor concrete facilities, 100 bays, in the middle of downtown Chicago, that's going to take 3 or 3.5 years to get developed and opened. We don't want to put your capital at that risk. I'm very risk oriented with your money. We have our own money in this too, and lots of it. So we want speed to revenue. We want to find a site that we can that is properly situated for our business plan. We want to develop it, build it, open it fast, so that you have a continued increased revenue occurring. Overall company plan. Yeah, 200 facilities in 10 years. That would probably be $1 billion in revenue. The development and management expertise that this company has allows for, when we're up and running, let's say a couple years from now. Right now, we have the capacity to build and open 3 to 5 of these at a time. That capacity will grow over the next 3 years to say between 15 and 25. Our president is the former chief operating officer of the Cracker Barrel restaurant chain, and he spent 15 years opening no less than 25 Cracker Barrel restaurants at a time in as many states. So there's tremendous immunity to growth problems in this company. And as I said earlier, we want to do these smaller, real cute, real decked out locations around the country. We count no less than 300 cities that we could be in right now, 300 cities. And areas like Tampa, Florida, where we are here, Atlanta, Georgia, have as many as 20 suburb cities that we would situate ourselves in quite nicely. So we're very much on top of real estate brokers and land brokers nationwide, showing us land all the time. We have very good general contracting, engineering, architectural relationships, so we can develop these sites quite efficiently. Okay, Beth. So what are the market opportunities here? As I said earlier, the newer generation of golfer is looking for, affordable, less time consuming, and less intimidating ways to embrace the game. That word intimidating is interesting, because if you're not that great a golfer, you can have a very embarrassing time out on a traditional golf course. I can speak from great personal experience there. You're out there with good golfers, and it can be intimidating. It can be very socially challenging. Here you go to our facilities, and you're just in a complete bouillabaisse of different skills and techniques, and you have a lot of people there that I've seen people the last couple of days at Tulsa. It took 20 swings before they could even hit the ball, and right next to that person looked like a 0 handicap golfer, and everybody just getting along, having a great time. Technology, of course, is very much in play now. We have a couple of different providers for technology, but when you go to our facility, you're hitting balls out into a field, but you have a TV screen in front of you where you're able to pick any famous golf course you'd like, and you can literally play that golf course on our computer screen. That could be Pebble Beach, that could be Augusta National, that could be Bethpage, and so you have this wide choice of golf courses where you can kind of pretend that you're playing on the course. Again, as I said earlier, with this 50% of all golf participation being done in these kinds of facilities, we can't help but think that that's going to grow. And the time dedication needed to play 18 holes of golf is just becoming harder and harder for so many people. And this shorter time dedication to play, say an hour, hour and a half, opens itself up to, after work, take the parents and the kids go out after dinner during daylight savings, and there's just all kinds of variables that come into play that are not available in traditional golf. In all honesty, Topgolf really proved this, and they're an easy competitor to talk about because they're all over the country in major cities, and it's just very clear that there are peak hours, but basically any evening of the week, our facilities, their facilities just jam up starting around 4 or 5 o'clock when work is done. And then you're having bachelor parties, bachelorette parties, anniversary parties, company office parties, holiday parties. The event side of this business is huge. So, that upward trajectory of off-course play is just a very major play. It's a cultural shift that this country is going through, which we, of course, want to exploit and be there to capture all of this unsatisfied demand that now exists. Okay, Beth. Partnerships, critical. We've got 3 very good ones. Cleveland Golf, Strixon Golf, both companies in the very strong in the equipment business, golf ball business. TrackMan is our technology provider, and TrackMan, for those of you who watch Major League Baseball, TrackMan is the company that gives you that square box that shows you strikes and balls when pitches are being made, and then gives you the pitching speed and all that kind of stuff. It's Doppler radar based, and it's just a superb technology for frankly, for those who really want to have a serious game improvement. In all honesty, there's probably half of the people really get into that at these facilities, while the other half are there for a little more for social purposes. But TrackMan is a very key relationship for us, and we're going to be adding more strategic relationships as we move on here. Just yesterday, I met with a company that's going to be doing our artificial turf, and they want to sign on as a strategic partner and do exclusively golf turf just for our company. So you'll see this list add as time goes on. Okay, Beth. Okay, why GolfSuites now? We have 3 operating facilities that are open, which means the company has pretty much gone through its, startup risk. We're operating 3 facilities. We're doing business. We're probably doing $12 to $15 million business a year. Each facility we open is going to come in at around $4 million. We have very, very material positive net operating cash flow. Over 30% of our investors are reinvesting. And frankly, I think that number has increased. We have a phenomenal investment repeat ratio here. And out of 3,000 to 3,500 shareholders now, it's interesting, we get asked about selling shares once in a while. And I tell the people asking the question that not one share of this company has ever been sold. It's an amazing statistic. I'm amazed at that myself. I've been doing this kind of business for 4 decades, and I've never experienced anything like this. So I think it's that, we're getting serious investors who have a good long-term view, and frankly, they're very satisfied. If you look at our offering circuit, you look at Nick Flanagan, you look at Scott McCurry, you look at the people who are running this company, multiple decades of experience in food and beverage. Nick, our president, was the senior management official at Cracker Barrel, 77,000 employees spread among 650 locations. He had 700 people just at the home office. I mean, this guy really knows how to run a big shop, and he was extremely successful there and decided to, kind of strike out on his own with us as a major ownership piece of the company in exchange for doing this. Scott McCurry from Topgolf, he was involved, I think, with 35 of their openings. So you have a phenomenal combination of golf entertainment with one guy, food and beverage with the other. They get along very well, and they really are inventing this company on a day-by-day basis. I already talked about number 4, 20 new facilities in the next 24 to 36 months. It says acquire and rebrand. Frankly, that'll be predominantly acquire and build. I mean, I wouldn't be surprised if 20, all 20 are brand new. We're very real estate oriented. So we're very, we have high affinity for new land. We build the facility, we own it, and so we have a real estate growth and value as we march down the path. Okay, Beth, apologize for this sniffles I have here tonight. Okay, so I've gone through the basics of the investment, and it's over time, having done a few of these, I've been asked, questions in these webinars that kind of lend themselves to a little more of an advanced discussion. Given this group tonight from Investors Alley, we surmise that this crowd tonight is a little more perhaps investment affluent and understand things a little better than maybe the typical Reg A investor. So I wanted to add this in, and we're going to just talk about, we're going to kind of up the ante here a little bit, go from high school into college here, as it were. So go ahead, Beth. Well, certainly the inspiration, I think we have clearly talked about. The growth, our competitors' growth is just unrivaled, and this tremendous lack of supply just drove us to this. We are if you were to say, Jerry, what are you guys doing? You can answer with one sentence. What are you doing? From an economic standpoint, I'd say we are exploiting a proven concept. We have discovered that this thing works. This idea essentially works everywhere. We've viewed this in 15 different states. There's nowhere it doesn't work. It works in Miami. It works in Buffalo, New York. It works in 100-degree weather, and it works in snow. So it just is a working concept. The supply-demand scenario is really the key. Here's another little question I would pose. I just answered the question, what are you guys doing? Now I'll throw a question that an investor would ask me, Jerry, why should we do this? You got a chance to give me one reason we should make this investment. And people could come back and say, well, we've got better facilities and golf is really changing and all these different reasons. And I say, no, that's not what you're doing. You're doing this because of a supply demand out of balance that is so acute. If we were sitting here tonight pitching you on some new restaurant concept, I couldn't say that. I can say, well, our steaks are going to be better, this, that. I could not tell you it's a supply demand situation, because no matter where you are in America, you're a few miles away at most from a whole string of restaurants of any kind you could possibly imagine, but you're not close to this. And if you are close to this, you're close to one. A very interesting fact, if you live in Tampa, Florida, you've got one. If you live in Columbus, Ohio, one. And you got hundreds of restaurants, hundreds of gas stations, dozens of home supply companies, office supply, clothing chains, one golf entertainment center. One could say, does it matter whether you're even better than the competitor? Of course, we feel we are better than the competitor. But if this were an economics class I was teaching, I would say to my students, I'm not even sure we have to be better. We are better, but I don't know that it's a necessity, because the supply demand, if you can see my hands, is like this. The supply is here and the demand is off the chart. So we're in these cities we're in now, we're Tulsa, Lubbock, Baton Rouge, we're going into Jackson, Mississippi, we're going into Auburn University. Looks like we're going into Pensacola. We want to go into Birmingham. But as the years go by, you'll probably see us in Boise, Idaho, Spokane, Washington, Salem, Oregon. I mean, Springfield, Illinois. God knows, all these lovely kind of secondary towns, hopefully with good education, good college base. And we are basically want to usurp. We want to exploit this shortage of supply. So what are we doing? We're exploiting a proven concept. What are you doing? If you invest, you're investing in an acute undersupply over demand situation, which I would advise you look at in anything in which you invest. That supply demand out of balance is a key economic driver in success. Lastly, on this page, I have obviously touched on this. When we look at our competitors, we can clearly say that we have the highest quality management team. We just simply do. We have a 40 unit Top Golf exec. We have a 650 restaurant chain, a chief operating officer. Those are our two top guys, both with tremendous operating expertise, tremendous management, personnel expertise, and tremendous development construction expertise. It's just a very cool team. I saw to it that these two guys got material ownership in the company. If you do buy shares in this company, you're sitting right next to us. You're just owners in this company like we are. There's no hedge funds. There's no Wall Street. There's no nothing here. This is essentially is a family business, and you buy shares in this, you're essentially becoming part of the family. But if you get into the offering circle and read about the management team, you'll be very impressed. Anyway, that's a little more about us. Supply demand factors. Some of this I've already, gone through. The value proposition is, of course, management that I just discussed, efficient design and development speed. That's speed to revenue. That's why we want to do these smaller locations. We might even end up with 2 or 3 locations in single metro areas because they wouldn't even compete with each other. Supply demand I talked about. And in my opinion, folks, that's your reason for investing here. Given that you like the concept, given that you like the management team, given that you like generally what I'm saying tonight, your key driver here is supply demand. This country has less than 100 of these. It should wake up in 10 years with 300 or more, at least 300 or more of probably what would be 4 or 5 of us brands. I've already talked about this too. I said 300 to 500 locations of facility type in all 3 sectors of locations: major, secondary, and tertiary. And again, folks, that plots against something like 80 now. One company can't do it all. I mean, we will have other competitors. We're delighted to have, because everybody that opens this concept up simply continues to prove the success of the concept. Constrained supply. I'm sorry to be hitting this so hard, but it really is the key reason. Anything that's in short supply creates natural demand. I mean, if there were 5 of us in the desert and just having not drunk anything for a whole day, and there was a bottle of water sitting out there in front, we'd all be running pretty hard to get that bottle. That's limited supply, very heavy demand. It's a natural human encounter, and that truly is what we're economically exploiting here. The last thing, of course, what does that supply demand relationship manifest in? Obviously, favorable pricing and higher than normal profits and a greater than average yield. Our yield for the first 6 months on our first 2 utilities, yield on equity, was north of 30%. We're paying an 8% dividend, so you have 22 percentage points of yield that is able to be reinvested in future sites. So we're very mindful of that, very proud of how it's performing right now. We are indeed a small company. We're still new. We're still raising capital. We're going to be raising capital for a long time because we like this venue. We like this type of shareholder relationship that we have, and we want to offer it to a lot of people. They can take part of this. With other companies, they just can't. Okay, Beth. Yield. Yield is a very interesting term. It encompasses many things, from simple to complex. The simplest thing in the concept of yield is your dividend. You're going to get, you invest $5,000, you're going to get $400 a year. Invest $20,000, you're going to get $1,600 a year. That dividend goes to you. That's step 1. No, take that back. Let's call that step 0 with the screen here. Step 1 then becomes, what does the company make in profits in excess of the dividends it's paying you? That's cash flow in excess of dividends. And what happens with that is that excess can be reinvested in future developments. Those excess cash flow returns combine with continued share sale to give an exponential growth factor to the company. And so that's what is going on here. We in management are not taking out any dividends. We're not taking any bonuses. We're not doing anything like that. We're letting this money, essentially reinvest. Now, point 3 gets a little advanced, because we also do joint ventures with private investors and private equity groups with very large sums who come in and invest a certain sum of money, and we override their interests so that someone might come in on a pro rata basis with 75% of the capital and only receive 37.5% of the profits. So we're leveraging off that investment that they make, and that further leverages the equity that you're investing. So, on this page here, I invite whoever is on here tonight to, consider this, because we might we might have a separate webinar on something like this. I've done separate webinars on just this page because it's a lot to explain in one sitting like this. But I have frankly quite some experience in joint venture. I probably have about 300 million of equity formation on my resume, and a lot of it has been with large investor groups teamed together with smaller investment groups like our Reg A shareholders now. It's very easy to do. Everybody's very happy with it. But you want us doing these things here to aggressively yet responsibly, grow this company. Okay, Beth. Result: cash flow in excess of dividend, plus continued reinvestment, plus leveraged equity cash flow, plus continued share sales at higher share prices is basically leveraged equity growth. That continued share sales at higher share prices, you should know, we're selling at $13 a share now. 3.5 years ago, it was at $5. And we have more people buying shares at 13 than we did at 5. And we have literally hundreds of investors who came in at $5, $6, who are buying shares at $13 today. So it's very interesting. And I don't allow these shares to trade yet because I don't want any risk of short selling or anything like that. And so it's a very stable, the market making is very stable. We determine the share prices ourselves. We don't, if someone thinks our share price is too high, they just don't have to invest. But we get virtually no protest, no back off on the share pricing that we charge. Okay, Beth. The facility account will grow on two principal factors. Some of this is frankly a little repetitive, but that's okay. Continued share sales and reinvestment of cash flow dividend payment. I determine the share price. I mean, I am essentially the market maker, and I hold those authorities myself. I'm the essential founder of this company, and so and I'm the largest shareholder, so I have certain kind of powers that are vested in me, and so I'm very serious about that there. And it is true that every time we've sold shares, the higher share price, we sell more shares. I think that is a function of, I think it's really a function of supply demand. I think the supply demand on the customer side is one thing. This country needs more facilities, but I also think there's a supply demand issue in the ability to be an investor in this kind of a business because we're the only one you can be. There are other companies out there, but they're institutionally owned. One is a public company that has 4 facilities like ours, but it's only like 5% of their business because they're a big golf course country club management company. So to be involved in golf, driving range entertainment as a shareholder at will, just get on the phone and buy shares. We are the only company in which you can do that. Reinvestment of cash flow, again, material yield in excess of dividend payment. You really want that when you buy shares. You want to know that the company is making more money than it's giving you, because that's where growth comes from. If it's giving all of its profits to you, there's no growth potential. But if it's making more than what it's paying you, and then combining that with new share sales, you have a great opportunity for exponential growth. 25% yield estimate is what we shoot for and are achieving. And that plots against an 8% dividend rate. That leaves 17 percentage points for growth. And so that's what we project in the offering circular itself. Under federal law, we're not able to project anything at all. I can't answer you tonight. Hey, Jerry, what's my stock going to be worth in 5 years? I'm not allowed to even speculate on that. It's against the law to. And so, but we can say that we have high confidence and very good growth here. Okay, Beth. Risk management. Cash flow in excess of dividends, we've already talked about. Management plans for excess growth, we've really talked about that. The stability of share price, we just touched on, because this is not a trading stock. So you don't have a risk of it paying $13 today and it's worth $8 in 2 weeks. You don't have that risk. I think a key thing that we don't talk about much, and really one of the most important points on this page, or the most important point, is that the key executives of this company are major owners. This is what's called a management-owned company with the same position with you. There's about 3,500 of you, or maybe 3,000 of you now, shareholders in this company, along with some of the founding shareholders and key members of management. We all are partners in business here. We had a meeting in Tulsa yesterday morning with some contractors, and I looked around the table and said, well, this guy's name was Jim. I said, Jim, for what it's worth, 70% of the ownership of the company is sitting at this table. And so whatever decisions we make here, we have the power to make that. That's a very good thing for you, because you have key executives who have major skin in the game, major incentives to see this thing go through, because I have essentially gifted them with major pieces of ownership to come on and join us. So go ahead, Beth. Exit strategy. Everybody wants to know what's the exit. That's a very American concept. And of course you want to know that. I can't predict what that's going to be. We have valuation concepts, how's the company valued and so forth. I mean, the real important thing is as follows. Jerry, what happens in 6-7 years? What are you going to do? It's not a question we're going to really deal with until I see at least 40, 50 locations. And well before that, I'm sure we're going to be getting a lot of attention. We'll be getting a lot of attention from major funds and major operators who have interest in expanding their business. The 4 primary ways to monetize or to convert your shares to liquidity. The first, of course, is IPO, initial public offering. I do not tell my shareholders that is something to really count on. I don't really know that is something we'd want to do. It's extremely involved, and I just don't really know. That would be a real function of where the stock market would be at that time. Second option is an outright sale. Topgolf comes along, Callaway comes along, TaylorMade comes along, Brunswick, Revlon. Revlon buys all kinds of athletic companies. The Revlon makeup company, they own Mastercraft boats, and they own Coleman camp goods. I mean, they have all kinds of sporting type stuff. That's a possibility. Public merger is what I like the best, because if we were to merge with a public company, then your shares in this company would be exchanged for shares in that company, which has already been public for years, doesn't have to go through the IPO pains and anguish. And then there's a private merger, which I really don't like. Private merger is bottom of the list. IPO is second bottom of the list. Outright sale is second to the top. Public merger is my favorite. That's what I would really like to target. So if some company came along and wanted to buy us, if they're a public company, we could arrange share transfer, and you shareholders would have the choice of taking all cash, all shares, or any combination of each. When you take shares in the new company, that transaction is not taxable. That's a tax deferred exchange. So you could really lay that out. And depending upon your age, tax deferral is a very important thing, because when one dies, whatever the tax accumulations are that have not been paid are erased with death. It's a very important factor for people in my age bracket that, you're doing estate planning. You want to push these tax-free strategies to the best you can, in the best manner that you can, because at death, all of those unpaid taxes on gain are erased. They disappear, and the assets at their current value go to your heirs, and there's no tax due then or at any later point in time. So again, Jerry's choice number 1, public merger. Choice number 2, outright sale. Choice number 3, private merger. Choice number 4, IPO. Good. Time will tell. Those choices, those tastes that I have can change. But right now, let's build the company. Let's build it up. Let's concentrate on growing it, and we'll deal with exit strategies later on. Go ahead, Beth. Okay, Ryan, why don't you step in now and talk about how to invest? I'm going to step away from the screen for a minute, and I'll be right back. So Ryan, go ahead and take over this.
Yeah, sure thing. So investing in GolfSuites, so we make it pretty simple. You just go to invest.golfsuites.com/opportunity, and it's a webpage with all of the information right there. It has a link to our offering circular, and there's a couple of buttons on there that say invest now, and you get right into it there. Otherwise, with any questions, emailing it's very simple. Just investors@golfsuites.com. It automatically emails me. It emails investor relations as well. If you're already a shareholder and you have questions about your account, or if you want to switch to direct deposit or anything like that, and it automatically forwards to me. So again, any questions you have, I can answer it there, or again on our upcoming Q&A here in a matter of minutes.
Good, good. Are we ready for questions now, Ryan?
I believe so.
Okay, who's gonna?
Yeah, so anybody, go ahead and just put them into the Q&A. Beth will ask them here, and then Jerry will answer.
Yeah, thank you so much, Jerry. That was very informative. We've got a couple questions here already.
Okay.
But if any more come in, feel free to put them in the Q&A and we'll get to them. First question, Jerry, is how do you make it so that the dividends are tax deferred?
They're tax deferred. That's a interesting. That's what I call a 13th grade question. I got to explain this as carefully as I can because it's not easy. Under federal tax law, since the founding of the Internal Revenue Act of 1913, when a company pays dividends and that company is not paying tax itself, okay, the dividends are not taxable to the recipients, the shareholders. When a company is paying tax, when a company has taxable profits, we'll talk about taxable profits here in a minute, the dividends are obviously taxable. In our company, we have positive cash flow from which we pay the dividends and from which we grow the company. But we have depreciation write-offs. We have some very favorable tax treatments that we're able to deduct against the income that eliminate the taxable portion of the income. So, and that's going to exist for several years because of our planned growth. So that is how that occurs. Now, I will tell you this, that's not an easy topic to assimilate. If and Ryan, make sure any of these folks on here have my phone number direct. They can just call me if they want to. If you have a kind of an advanced level CPA doing your tax work or know of one, they will confirm what I'm saying. It's not often discussed. If you were, for example, a shareholder in an oil company, say Exxon, and you were getting $3,000 a year in dividends, you'd probably see that like half of your dividends aren't even taxable because Exxon gets all kinds of tax treatments that it can deduct against its income. And in the dividends that it pays its shareholders, those tax advantages are passed along. So we have, when you get your tax form from our transfer agent, it actually shows the dividend in the non-taxable box. Hope that answers it. But if it doesn't, make sure that there's access to me here, Ryan and Beth, so folks can call me if they want to discuss that further.
Thanks so much, Jerry. Our next question here is, would the northern U.S. be a good spot due to limited yearly golf access?
With limited yearly golf access?
Yeah, due to the limited yearly golf access.
In my opinion, the North is one of our best areas because you get up into Cleveland, you get up into Buffalo, Rochester, and even Milwaukee, places like that, Minneapolis. I have never lived there, but I understand that golf pretty much shuts down during the winter. And then what does everybody do? Well, you come to GolfSuites with our heat blasters and covered space and some nice, some nice warm cocktails while you're hitting the ball. I mean, we're definitely going to do that. We're concentrating on the Southeast now, Beth, because of management efficiencies and the population growths that are going on. But clearly the northern cities, and there's hundreds of them that would just take this product nicely. Even in our locations now, I was in Tulsa night before last, and it got very cold, and the heat blasters were on, and just shooting the heat down, and everybody was just out there having a blast. But I think it applies if you were to go to Topgolf in Chicago, Topgolf Philadelphia, Columbus, Ohio in December. I mean, they're jam-packed. They're just, you can't even get in the place because golfers have nowhere to go.
Makes sense. Makes sense. All right. Our next question is, what is a realistic exit strategy scenario?
Well, I went through that. That question may have come in before I discussed that. I mean, I gave you those four options a page or so back. Realistic to me, I don't know if that's asking about time. I think if that's a question as to time, I would say you want to look for that in no sooner than 5 to 7 years from now. Absolutely no sooner than that. And Jerry likes public merger. I've done a little bit of this in my life, and public merger with the right company can really just be the cat's meow, because it's you're exchanging your shares for shares in the merging company. And Beth, you can say, well, I want all new shares. Ryan can say, well, I want all cash. And I'd say, well, I want half cash, half shares. You do whatever you want. If you don't like your shares, 2 days later, you just turn around and sell them, or sell some of them, or sell most of them. So it's tremendous flexibility. I don't want people thinking that I'm going to commit to an IPO, to an initial public offering. I'm not saying I won't do it, but it is a tremendous involvement. And I think, frankly, that the GolfSuites company, say at 50 locations, is more well suited being part of a big major company that has other divisions and stuff. So you transfer your return expectancy, your rate of return expectancy from just this one company. Now it merges in, and now you've got a piece of this whole bigger thing. So public merger is my favorite, but no sooner than 5 or 7 years from now.
Thanks for going into more detail about that. Very helpful. Yeah. Our next question is, how can I pay for shares? Can you invest with an IRA or 401k?
Okay. Ryan, you can talk about how to pay for shares. It's funny you say IRA. We're just doing an incorrigible amount of IRA work right now. We actually do IRA seminars, and I'm going to talk with Jared and Adam at InvestorsAlley about this, because we Beth, we may want to do an actual IRA GolfSuites webinar. We have done those about, I think, Ryan, haven't we done about 2 or 3 of those? And we are just collecting unfathomable sums of shareholding from IRA. And a lot of people don't understand it. Something like 97% of IRA 401k money is just sitting in money markets and Merrill Lynch and stuff like that. And people don't even realize they can self-direct some of their investing. And so we deal with a couple different firms. We specifically deal with the IRA Club in Chicago. We have a very close relationship with them. We do joint webinars with them. And I'm going out of my way to introduce them to Jared and Adam at InvestorsAlley, because I think InvestorsAlley subscribers would like to know a little bit more about self-directed IRA and the fact that they can invest in something like this. So Ryan, let's make sure we get good direction from whoever asked this question and whoever else, to come in and talk about IRA investing. I want to say, I don't know, it may be constituting half of our business right now. It's just a huge piece of what we're doing.
Right. And another advantage is that since this is considered more of a long-term investment, people who put it into their IRAs are usually in it for the long haul anyways. So a lot of people are finding that advantageous, along with stopping any current bleeding with the stock market as it is. As far as payments for that, we accept all forms of payment. Our facilitator has credit card processing, ACH, bank-to-bank, direct deposit. You can also do check or wire if you prefer that way. And we actually do have a crypto account set up with Gemini. So if you want to throw anything out with Bitcoin, Ethereum, Stellar, anything like that, we take all forms of that as well.
Great.
By the way, Ryan, on the webinar tonight, is our link available anywhere? Can people link on, or they have or?
Oh yeah, I will. I'll put a direct link on the chat for everybody on the webinar here as well.
Okay, good. So they can just link on and see it. That's great.
Great.
Now, isn't it true, Ryan? We already have some InvestorsAlley members having bought stock, huh?
Yeah, we have quite a few of them.
Yeah, that's great. It's a great relationship we have.
Fantastic. Thank you so much, Ryan. Thank you, Jerry, for that information. We'll move on to our next question. Why crowdfund instead of going straight to venture capital?
Well, do we have 40 minutes for that answer? By the way, that's a whole webinar in and of itself. Um, crowdfunding is a meeting ground of Wall Street and Main Street. It's where Merrill Lynch meets Amazon.com. The purpose of the Jobs Act of 2012, which basically promulgated this whole Reg A movement, was to allow, what should we do? Just allow any citizen, any person to invest in new venture capital opportunities. Heretofore, cordoned off to the hedge funds, wealthy people. If you were a big investor at Merrill or Goldman or one of these companies, your stockbroker would call and say, hey, Beth, write out a check for X dollars when you get you into this public offering 2 days ahead of time. It's very common, nothing illegal about it, but for all intents and purposes, a bit unfair. I have been a part of that world. I've done all my stuff with venture capital, institutional financing. I've financed with so many major institutions. I like this for two principal reasons. It gives everyday people a chance to own a piece of something like this. It has a wide variance of investments. Today, we got an investment for $650, which is our minimum, and we got an investment for $130,000. I mean, someone please try to explain that. It just allows for anything. So on the investor side, I have a series of videos I did, and I started laughing at one of these videos. I said, GolfSuites is starting to act like the old-fashioned country corner grocery store. I mean, it's really a collective. It's really a family. We're like a commune here, and we have an investor relations manager who, she's sending out cards to, people for weddings and baby showers. I mean, and of course, people keep reinvesting. And so I'm becoming quite a Reg A shareholder advocate. It's interesting. I never thought this would happen. They just really have a tremendous sense of pride that they're able to own something like this and see the rather immediate results that they are. Now, from the management side, the flip side of that coin is that the Jobs Act of 2012 and current Reg A rules are written in a way that there has to be strong management control so that there's less chance of takeover and anything that would then invalidate what the investor actually originally decided to do. So, and so they want that strong control so that raiders, corporate raiders can't come in and stuff like that. We like that because we feel we know how to run our business better than a hedge fund manager, assistant director does. And so we really have autonomous management control of the entity. The Reg A shareholders are investing in us and we are managing the assets for them. It's very bilateral. There's no other parties involved. And it's very direct. I'm sorry to give such a long answer, but I really have become, on the personal side of this, very attached to it. And I've gotten to know just hundreds of these investors, primarily, by telephone. And they're just such a delightful group of people. And they really would not have been able to be part of this. They wouldn't have been able to. Now, I think Reg A also has some investments out there that haven't gone that well. And so there's an opportunity to exploit people. So people have to be careful what they invest in, but a company like ours is very fundamental and comparatively speaking, a safe investment. So, but that's the answer. It's a more direct approach. There's no middleman. The investor is just investing right with us, sharing with us directly. There's no stock brokerage firm or hedge fund in there taking their cut, out of any of this.
Great stuff. Yeah, no, it sounds like a great thing to be a part of right now. And speaking of right now, our next question asks about the current economic situation and possible recession. How does the business model look under those situations?
I am a recessionary guy. I'm kind of a contrarian business guy. What does recession mean to a guy like me? Well, demand for land may go down, which means cost of land may go down, building supplies, equipment, those kind of things. Frankly, I think it's a little far-fetched. We talk about recession recession can be very theoretical, Beth, very theoretical. And we see it in the cost of things, which is terrible. Cost of gas, cost of food. I mean, it's disgusting what's going on now. We happen to be in the affordable entertainment business. And so where recession may hit us is that 5 or 6 people come to share a golf bay instead of 2 or 3, thereby lowering the cost. And, maybe they have a couple of beers and a hamburger instead of 4 or 5 beers. And I don't really know, to be honest with you, but we don't see anything recessionary hitting our top line. Tremendous number of repeat customers. I think that we could be in a recession right now. You could argue that we are. And I think that if someone is trying to grow a business that is on the affordable side of things, frankly, he's going to like a recession because it's going to depress costs and it's going to make things easier to buy as compared to a strong economy that we had, where the demand is so high. You saw what happened with housing here. Housing with interest rates below 3% as we moved at the end of 2021. Today it's 7. I mean, it's bizarre what has happened there, but with that in mind, were I a home builder, I might be liking this because that land over there and that land over there that was so expensive to buy might be a little cheaper now because the demand goes down. Recessions themselves are meant to decrease demand, and decreased demand obviously lowers prices. So I don't want people hurt by a recession, but I don't particularly think they hurt what we're trying to do.
Right. Makes sense. All right, we have time for.
And by the way, if we were raising money now to sell $2 million timeshares in Hawaii, I think I'd be a little concerned about recession. But that's not what we're doing. We're on the affordable side of life here.
Yeah, makes sense. For sure. So we have time for a couple more questions here. Our next one is, if I invest today, when would I start receiving distributions?
At the end of the quarter in which you invest. You're in the 4th quarter now. If you invest today, your dividend will be prorated till the end of December, and you'll get that dividend in the second half of February. Our dividends go out in the second half of the middle month of the following quarter. So your 4th quarter dividend will be second half of Feb. Your 1st quarter dividend next year will be second half of May. It takes about 6 weeks for our transfer agent to do all the computations and stuff, particularly new shareholders, because they have to count the days that the money was there. And of course, once you're in, then it's just the same amount each quarter. So if you invest on December 28th, you're going to get 3 days worth of dividends, in the second half of February. So the dividends start the day you're in.
Great. Thank you. All right. What I think will be our last question is, what are the advantages in investing in GolfSuites over somebody like Topgolf, who is more established?
You can't invest in Topgolf. Topgolf is wholly owned by the Callaway Golf Company. I love that question. I love it. I'll tell you something. If Topgolf was doing crowdfunding, I'd have big problems here, Beth. I can't deny that. I'm going to be very honest with this crowd. Topgolf never was something you could invest in. They were thinking of going public. For some reason, that didn't happen. I don't know what that may be. They may not have liked the execution. They were trying to go public right in the middle of COVID, by the way. So I don't think that really helped things. Callaway Golf, which is a huge company out west, had a major ownership position with them. And there was a couple of founders who brought the company over, some Dallas people who brought the company over from the UK, and they basically just cut a deal with Callaway. Callaway is now owns Topgolf. I wouldn't be surprised if they changed the name over the next year or two and call it, Callaway Golf or something like that. But that is a wholly owned subsidiary of Callaway, and you can buy stock in Callaway because that's a public company, but you can't buy stock in Topgolf.
Great. Well, thank you so much, Jerry. Thank you for your time today. Thank you everybody here for attending. You've got a link in the chat from Ryan. If you want to get in touch with GolfSuites, there's some information here on your screen right now, phone number and email, as well as a website. Again, there's also a site in the chat. Thank you everybody so much for attending. And Jerry, thank you as well for your time. It's been very informative.
Well, thank you for hosting us, Beth. You've done a great job, and many more of these to come. We hope to do many of these with the Investor Alley people. We'll again talk to the management folks, Adam and Jared. Hopefully do a couple a month with Investor Alley, and we'll try to do one with some IRA people as well.
Great. Great. Thank you so much again, Jerry.
Thanks. Okay, thanks, everybody.